वो है binomial model. So we were saying that we are going to use the binomial model to calculate the no arbitrage premium of an option. ठीक है? And uh, you know, we were saying that the binomial model says that there are two possible prices of an underlying after one period, right? So the first movement is that the price of the underlying uh, increases from the current market price, right? So S0 is the current market price, and the second movement is that the underlying decreases from the current market price, right? And at the end of this one time period, now the one time period is going to end somewhere here, and at the end of this one time period, the underlying can be worth only one of these two possible prices. Now we were saying that this is not realistic. The underlying can be worth anything. It could be worth anything within any given range. But this binomial model is saying that the price of the underlying in one time period can be one of the two possible prices. Okay. Now we were saying that to calculate the two possible prices, we need to calculate the volatility of the underlying. That is, we need to calculate the standard deviation of the prices of the underlying asset. So we were saying that uh, that if the standard deviation of the prices of the underlying asset is 20%, right, then the price of the underlying in case of an up move is going to be 1.2 times the current spot price of the asset, right? And we were going to say that 1.2 is the size of the up move, right? We'll call 1.2 as the size of the up move. And in case of a down move, the price of the underlying is going to be 1 by 1.2 times the current market price of the spot asset, right? In case of a down move, right? And this 1 by 1.2 is equal to the size of the down move. Or another way of saying the same thing is that 1 by the size of up move equals the size of the down move. Okay, so if the volatility of the underlying is 20%, current stock price is 100, and say that one time period is 1 year, then the price of the asset in case of an up move is going to be 1.2 into 100, which is 120, and the price of the asset in case of a down move is going to be 1 by 1.2 into 100, which I think we had calculated to be 83.33, right? Okay, now the price of the asset in case of an up move, that is 120, we are going to denote it as S plus, and the price of an asset in case of a down move, that is 83.33, we are going to denote it as S minus. ठीक है? Okay. Now we had also discussed that there are a lot of traders in the market, right? And you know all traders assign different probabilities to up move and down move, right? So maybe Ashay is assigning a probability of Ashay says that there's a 60% chance of an up move, 40% chance of a down move. Kunal is saying that there is a 50-50 chance of a up move and a down move, and uh, Ayush is saying that there is a 30% chance of an up move and 70% chance of a down move. Right, so different traders in the market are assigning different probabilities to up move and down moves. But all the traders in the market agree that the underlying price of the underlying asset can move from, the price of the underlying asset will be 120 in case of an up move, or 83.33 in case of a down move, right? So all of us agree that in case of an up move, the price would be 120 and nothing else, and in case of a down move, the price would be 83.33 and nothing else, right? So what all of us tend to agree on is that there are no other price movements apart from these two. Okay. Now what we are going to do is to calculate the no arbitrage price of an option, or the no arbitrage premium of an option. What we are going to do is we are going to create a hedged portfolio, and you know where, in this hedged portfolio we are going to go long on the spot asset, and buy a put we are going to buy a put on this spot asset, right? Say this spot asset is some stock, right? And buy a put on the stock, and right. So how is this a hedged portfolio? Now, if the price of the underlying in the spot market decreases, we are going to lose out on the long spot position. We are going to lose money on the long spot, but some of these losses are going to get offset. That is, we are going to make up for some of the losses by gains on our long put. Remember, put prices rise when the price of the underlying in the spot market falls. So if the price of the underlying falls in the spot market, uh, we are going to lose on the long spot, but some of those losses are going to be offset by the gains on the long put position. So that is why this is a hedged portfolio. Okay, so um, what we do is, so the current market price of the stock is $100. The volatility of the underlying is 20%. So my S plus is 120, S minus is 83.33. What I do today is, this is time 0. This is, say, end of year 1, time 1. Time 1 is end of year 1. So I create a hedged portfolio today where I buy X shares of the underlying at S0, that is at 100 rupees, and I buy one put option. And we need to calculate the no arbitrage price of this put option. This is what we need to calculate. Okay. So I buy 100 shares of the underlying. Now this put option has a strike price of $100 and it expires in 1 year. Right, so it's going to expire at the end of 1 year, right? Some point here. Okay. Um, Now, what is going to be the value of my hedged portfolio in case of an up move? Now, these X shares of the underlying are going to be worth 120x in 1 year, and this put option is going to expire out of the money. Why is it going to expire out of the money? Because the price of the underlying is more than the strike price of 100. So since it's going to expire out of the money, its intrinsic value is going to be 0. Right, so intrinsic value of a put is uh, max of 0 comma x minus s. So x is 100 minus s. So max of 0 comma 100 minus 120. So that's going to be 0. Right, so since the price of the underlying, since S plus is more than the strike price, this put option is going to expire out of the money if the price of the underlying increases in 1 year, right? If the price of the underlying increases in 1 year, the put is going to expire out of the money, its intrinsic value is going to be 0. So value of my portfolio in case of an up move is going to be 120x, and in case of a down move, the my X shares are going to be worth 83.33x. And what's going to be the value of my put? Okay, so now in case of a down move, the put is going to expire in the money. right? It's going to expire in the money because the strike is more than the strike price is more than the price of the underlying in case of a down move. Strike price is more than S minus. Okay. So what's going to be the intrinsic value of the put? Please tell me what is going to be the intrinsic value of the put. बोलो क्या होने वाला?
16.67.
Max of 0, x minus s minus, which is max of 0, 100 minus 83.33, which is 16.67, right? Now we have the value of our portfolio, hedged portfolio, in case of an up move and in case of a down move. Now we are going to calculate x in such a way that the value of my portfolio stays the same irrespective of an up move or a down move in the underlying, right? Okay. Um, so the value of my portfolio in the case of an up move is 120x, and the value of my portfolio in case of a down move is 83.33x plus 16.67. So we are going to calculate x in such a way that the value of my portfolio in case of an up move, that is 120x, equals the value of my portfolio in case of a down move, that is 83.33x plus 16.67. So we're going to solve for x, and in the last class we had done that. X was around 0.4546, right? So what this basically means, that we are going to buy, if we buy 0.4546 shares of the underlying at time 0, at this point at time 0, then the value of my portfolio is going to be the same irrespective of whether the underlying increases or decreases in 1 year. Okay, so value of my portfolio in case of an up move, if I buy 0.4546 shares of the underlying, is going to be 120x, which is 120 into 0.4546. ये कैलकुलेट करना कितना है? 120 into 0.4546. बोलो ये कितना है? बोलो बोलो बाबू, बोलो कोई. 120 into 0.4546.
54.55.
तो 54.55. And the value of my portfolio in case of a down move is going to be 83.33x plus 16.67. That is 83.33 into 0.4546 plus 16.67. How much does this work out to? ये calculate करो. This must come to 54.55 only, right? This and this should be equal, right? Because we calculated x in such a way that the value of my portfolio stays the same in 1 year irrespective of whether the underlying increases or decreases. ठीक है? Okay. अभी see, this is a hedged portfolio that we've created, right? This is a hedged portfolio that we have created, and we've created a portfolio that combines a spot asset and a derivative on that spot asset. And we know that such a hedged portfolio which combines a spot asset and a derivative on the spot asset always earns the risk-free rate of return irrespective of what the price of the underlying is at the expiry of the derivative contract. And this is something that we had done in the first class itself, right? This is something that we've learned in the first class. So let me give you an example of this. Say the spot price at time 0 is $100, risk-free rate is 3%. Then the forward price of a forward contract that expires in 1 year is going to be S0 into, the no arbitrage forward price is going to be S0 into 1 plus RF to the power t, which is 100 into 1.03 to the power 1, that is $103, right? So this is going to be the no arbitrage forward price of a forward contract that matures in 1 year, right? So what we do is we create a hedged portfolio at time zero. What we do is we create a hedged portfolio. How do we create a hedged portfolio? We go long spot at $100, and to hedge our long spot position, to hedge our long position on the spot asset, what we go do is we go short on this forward contract at a forward price of 103, which is also my no arbitrage forward price, right? So this is my hedged position. I short the forward contract to hedge my long position on the spot asset. Now, what is my investment in this particular trading strategy? What is my investment in this particular portfolio? Right. So, if I go long on the spot asset, I have to pay the price of the spot asset to buy it. Right. So, my investment is going to be the current market price of the spot asset, that is $100. Right. And when I short a forward contract, I have to pay nothing. Right. So, we had discussed at initiation that when we trade in a, when I short this forward contract, I have to pay nothing, right? So we know that in the first class we had discussed that when you trade on a forward contract, no cash changes hand. You don't have to pay anything if you buy a forward contract, and you don't get anything when you sell a forward contract. No cash changes hand at the initiation of a forward contract. So you have to pay nothing, or you don't get you have you don't have to pay anything to buy a forward contract, and neither do you get anything to short a forward contract. So here no cash involvement, there's no cash involvement here, but you have to invest $100 to buy the long spot. So your net outflow in this strategy is $100 at time zero. At time zero you have to invest $100 in this strategy, in this portfolio. Now let's fast forward to the maturity of the forward contract. Let's say 1 year has passed and we are standing at the maturity of the forward contract. Right now, S capital T denotes the price of the underlying in the spot market at the maturity of the forward contract, which is capital T. Now, the spot asset could be worth anything in 1 year. It could be worth 80, 90, 100, 110, 120, 130. Okay. Let's calculate the payoff on this particular portfolio that we had created at time zero. So we were long spot at 100. Price of the underlying at expiry of this forward contract is 80. So what is my gain or loss on my long spot? I lose 20. If the price of the underlying is 80 at expiry of the forward contract, then I lose 20 on my long spot. If it is 90, I lose 10. If it's 100, no profit, no loss. If it's 110, I gain 10. 120, I gain 20. 130, I gain 30. And let's calculate the payoff of the second leg of that portfolio. We had shorted forward at a price of 103, right? So I had shorted the forward contract at 103. um, so the price of the underlying at expiry, if the price of the underlying at expiry is 80, my gain on the forward contract is going to be 23. If it is 90, my gain is going to be 10. If it's 100, 3, minus 7 if it's 110, minus 17 if it's 120, minus 27 if it's 130. So I'm going to calculate the net payoff for this portfolio. Plus 3, oh sorry, 813 over. 103 minus 90 is going to be 30. So irrespective of what the price of the underlying is in 1 year, I'm always going to make $3 on this particular hedged portfolio, right? So I'd invested $100 at time zero, and I gain, I gain $3. The profit on this particular strategy is $3 at the end of year one. So my return on investment is 3, which is what I've earned, and divided by 100, which is what I invested. Right. So my return on investment on this particular strategy is 3%. Right. And 3% is basically the risk-free rate of return. Right. So when I create a hedged portfolio, when I combine a long spot with a correctly priced derivative on that spot asset, what I'll earn is a risk-free rate of return. Right. What I'll earn is the return on a very safe investment. That is an investment which is free from default risk. That is the risk free rate. Right? So always remember that the combination of an long spot and a derivative on that spot is going to give me a return which equals the risk free rate of return, irrespective of what the price of the underlying is at the maturity of the forward contract. I hope this is clear. किसी के अभी तक डाउट है? बोलो गाइस, कोई डाउट है? आशय,
नहीं सर, कोई नहीं।
आयुष, कुणाल, किसी को कोई डाउट?
No, sir, no doubt.
कुणाल, तेरे कोई डाउट? कुणाल सुन रहा है? कुणाल, ओके। तो मैं, इफ आई इन्वेस्ट $100 at time zero, that $100 is going to become $103 in 1 year, right? If I take this example, if this portfolio gives me a 3% return in 1 year, then my $100 becomes $103 in 1 year. ठीक है? Given a risk-free rate of 3%. राइट। अब मैं अपना ये वाला पोर्टफोलियो का बात करता हूँ, राइट, where I was long 0.4546 shares of the underlying. I was long 0.4546 shares of the underlying, and I was long one put. ठीक है? So this was the strategy that I executed at time zero. Now I know that the value of this portfolio at the end of year one is 54.56, right? Because I have bought, um, I bought a quantity of shares that ensures that the value of my portfolio is the same irrespective of whether the underlying goes up or down. Right? I've bought 0.4546 shares of the underlying that ensures that the value of my portfolio is the same irrespective of whether the underlying goes up or down. Right? So, what should be my investment in this portfolio at time zero? This is something I need to calculate. What should be the investment? What should be my investment in this portfolio at time zero
54.56 divided
by the risk-free rate, right? So we know that this portfolio is going to earn the risk-free rate of return over the 1 year period, right? And it earns the risk-free rate of return. This portfolio is going to earn the risk-free rate of return over the 1 year period, and it's going to become 54.56 at the end of 1 year. So my investment at time zero uh, is going to earn the risk-free rate of return over this 1 year, and it's going to become 54.56 at the end of 1 year. So my investment at time zero is going to be 54.56 divided by 1.03, which is how much? एक बार निकालना, कितना निकलना? बोलो गाइस कितना आ रहा है? कुणाल सुन नहीं रहा तुम?
सर आवाज आ रहा है?
हाँ.
सर 52.97.
This is my investment in this particular portfolio at time zero is going to be 52.97, right? Okay. So this this particular portfolio of 0.4546 shares of the underlying bought at 100 rupees plus one put, uh, you know should equal 52.97 at time zero. Now the only unsolved variable is the premium of this put option. Let's calculate this. So the put premium is going to equal 52.97 minus 100 into 0.4546, that is 45.46. कितना आ रहा है? बोलो कितना आ रहा है? ये आ रहा है 7.51. This is my put premium. बोलो clear है? This is the no arbitrage price. Now, if the actual price in the market is more than 7.51, then we are going to short the put option. And if the actual price in the market is less than 7.51, we are going to go long on the put option. Right? Now, the first question that will come into your mind is, uh, did what you and think did uh, do these probabilities matter? What you and think of the probabilities of up move or down move matter while calculating the put option premium? बस ये कहीं पे भी आया अपना कैलकुलेशन में?
नहीं.
Right. So it's so the probabilities that the individual traders assign to an up move or a down move do not come into the picture when we calculate the no arbitrage premium of the put option. ठीक है? What matters is the risk neutral probability. ठीक है? ये अब कैलकुलेशन जो सारा बैठाने का ना एक और तरीका है, वो सारा कैलकुलेशन, ये तो देखो लॉजिक है, बाइनोमियल मॉडल का जो लॉजिक है मैं वो बताया. दिस इज अ लॉन्ग प्रोसीजर, वी आर नॉट गोइंग टू यूज द लॉन्ग प्रोसीजर, बट दिस इज गोइंग टू गिव मी एन आइडिया कि बाइनोमियल प्राइसिंग होता क्या है. व्हाट वी आर गोइंग टू डू इज we are going to calculate the risk neutral probability of an up move and a down move. So how are we going to do that? How are we going to calculate the risk neutral probability of an up move or a down move? First, what is a risk neutral probability? Guys, do you have any idea what is a risk neutral probability? So what you and me think of the probability of up move or down move does not matter. What matters is this risk neutral probability. Now, what is this risk neutral probability? Now, this risk neutral probability is a probability assigned to an up move and a down move in the underlying asset that that kind of ensures that we earn a risk-free rate of return um, on a hedged portfolio, right? So this risk neutral probability is going to ensure that we earn a risk-free rate of return on a hedged portfolio. That is, we earn a risk-free rate of return on a portfolio that combines a spot asset and a derivative on that spot asset. That is the basic idea of risk neutral probability. And how am I going to calculate this risk neutral probability? So calculation of this risk neutral probability has a particular formula, right? So how, let's look at that formula. Now my risk neutral probability of an up move is calculated in this fashion: 1 plus risk-free rate minus size of down move divided by size of up move minus down move. So I had defined what the up move what were the size of the up move and size of the down move. So the size of the up move is 1.2, and size of the down move is 1 by size of up move, that is 1 by 1.2, and this 1 by 1.2 was nothing but 0.833. So my size of up move is 1.2, size of down move is 0.833, right? So I'm going to just feed all of this. We are assuming a risk-free rate of 3%, so 1 plus 0.03. Size of the down move is 0.833, and size of up move is 1.2 minus size of down move, which is this. So calculate the risk neutral probability of this of an up move in the underlying. ये कैलकुलेट करना। कुणाल सुन रहे तुम? कुणाल जवाब ही नहीं दे रहा आज। कुणाल, हेलो हेलो हेलो।
हेडफोन खराब है मेरा, सॉरी।
ओके, चलो आयुष ये कैलकुलेट कर एक बार, कितना आ रहा है, कोई कैलकुलेट करो।
$53.67%.
53.67%. This is the risk neutral probability of an up move. Now risk neutral probability of a down move is going to be 1 minus risk neutral probability of up move. ये कितना आएगा? Because you know the sum of probabilities of mutually exclusive and exhaustive events sum up to 1. So the risk neutral probability on up move plus risk neutral probability of down move should add up to 1, right? So that is why to calculate the risk neutral probability of the down move, I am deducting um, I'm deducting 0.5367, which is the risk neutral probability of an up move, to calculate the risk neutral probability of a down move. बोलो इसको करो एक बार। 1 माइनस कितना आ रहा है? 0 पॉइंट,
46.3.
46.33।
ठीक है। तो ये क्या बोल रहा है कि 53.67 चांस है कि ऊपर जाएगा एंड 46.33% चांस है कि नीचे जाएगा अंडरलाइन। अब जब अंडरलाइन ऊपर जा रहा है तो उसका दाम हो रहा है 120, और 120 के दाम पे पुट का दाम क्या है? पुट इज गोइंग टू एक्सपायर आउट ऑफ द मनी, इट्स इंट्रिंसिक वैल्यू इज गोइंग टू बी 0। और जब नीचे जा रहा है तो प्राइस ऑफ द अंडरलाइन इज गोइंग टू बी 83.33, or put is going to expire in the money, its intrinsic value is going to be 16.67. So what it is saying is that the expected value of the put option in 1 year is going to be the expected value of this put option in 1 year is going to be 0.5367 into 0, which is the intrinsic value of the put in case of an up-move, plus 0.4633 into 16.67, which is 16.67 is the intrinsic value of the put in case of a down move in the underlying asset. तो ये calculate करो, this is the expected value of the expected value of your put in 1 year. ये कितना आ रहा है? सीधा ये कैलकुलेट कर लो, 16.67 इंटू 0.4633। कितना आ रहा है 16.67 into 0.4633 कितना है
7.739.
7.73 ले लेते हैं. Okay, now this is the expected value of the put in 1 year. The what is the expected value of the put today? That is the present value of the expected put option premium. Okay, so we are going to discount this 7.73 by the risk-free rate for the period of 1 year. So 7.73 divided by 1.03 कितना आ गया 7.504 या 7.51 आएगा. And this 7.51 is exactly what we had calculated. ठीक है, तो ये जो ऊपर वाला लॉजिक से अपने कैलकुलेट किए, the risk neutral probability of up move and down move give us the same value, right? It gives us the same value. So this risk neutral probability of an up move and down move are calculated in such a way that that the hedged portfolio, that ensures that the hedged portfolio earns a risk free rate of return. ठीक है, तो वो ऊपर वाला लॉजिक, ये नीचे वाला लॉजिक is going to give me the same uh, same answer, right? This is a shortcut. We are going to use this in the exam, but I gave you the intuition behind ye shortcut. What is this shortcut trying to do? What the long cut is trying to do? ठीक है ना? So I gave you an intuition on that. Now we have the no arbitrage price of a put option which has a strike price of $100 and expires in 1 year. Now we want to calculate the no arbitrage price of a call option on the same underlying which has the same exercise price or the strike price of 100 and expires in 1 year, right? So we want the premium, no arbitrage premium for a call option that has a similar exercise price, similar maturity and similar underlying as our put option. So what are we going to do now? कैसे करना है? फिर ये सब कैलकुलेट करें क्या? फिर ये सब
खाली पे ऑफ चेंज करेंगे देंगे तो हो जाएगा ना, ऊपर वाला कॉल में
इतना
20
कुछ
डाल
करने
देंगे
का
तो.
जरूरत ही नहीं है. वी आर गोइंग टू यूज द पुट कॉल पैरिटी. ठीक है, we are just going to use the put call parity. What does the put call parity say? That the cost or the price of a protective put, this is my protective put, should equal the cost or price of a fiduciary call. Why should the fiduciary call and the protective put why should they trade at the same price or the same cost? Because they are going to give us the same payoff at expiry. Both these portfolios give us the same payoff at expiry of this call and this put. So they should trade at the same cost anytime before expiry. Okay? So we can use the put call parity relationship to calculate the call option ka premium. And this call option should have the same strike price as our put option. It should expire at the same time as our put option, and it should be on the same underlying as our put option. ये call option का everything should be the same. So my S0 is 100. No arbitrage premium of my put at time 0 is 7.51. C0 मेरे को calculate करना है. X is 100. My strike price. Risk free rate is 1 plus 3%. Risk free rate is 3%. So 1 divided by 1.03. Solve for C0. C0 कितना आ रहा है? C0 कितना आ रहा है बोलो? 107 point
10.43.
10.43 आ रहा है। मेरा 10.42 आ रहा है, चलो 10.42। तो मेरा C0 is the no arbitrage premium of my call should be 10.42। अब इसको ऐसे भी कैलकुलेट कर सकते हैं, ठीक है ना, इसको ऐसे भी कैलकुलेट कर सकते हैं, सिर्फ रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ एन अप मूव और डाउन मूव के थ्रू भी कर सकते हैं। वो भी करके मैं दिखा देता हूँ, वो 10.42 ही आने वाला है, राइट। अभी एक सेकंड, थोड़ा सा ये हैंग हो रहा है, इसको एक सेकंड। जब ज्यादा ज्ञान हो जाता है ये लोग भी बदमाश हो जाते हैं, हिल ही नहीं रहा, वन नोट ही बीमार हो गया। ओके, तो S0 है, मैं लॉन्ग में नहीं जाता, मैं शॉर्ट में ही जाता हूँ, राइट। S0 का दाम है अभी 100, volatility of the underlying is 20%, so my S plus is 120, S minus is 83.33, right. So say that I've gone long on a call option at time 0, I go long on a call at T0, and this call has a strike of 100 and it expires in 1 year, right. So if the price of the underlying increases to S plus, that is if it increases to 120, what's going to be the intrinsic value of the call in 1 year? Again, it's going to be max of 0 comma S minus X, that is 20, okay. Because these, this S plus is more than the exercise price of this call, right. The call expires in the money, and its intrinsic value is S plus minus X, which is 20. And if the price of the underlying goes down to 83.33, the call is going to expire out of the money, its intrinsic value is going to be 0, right. Now we already know the risk neutral probability of an up move and down move, which was कितना था, एक बार बोलना, 0.53, कितना था, कितना था एक बार बोलना, 0.53 कोई लिख रहा था क्या, बोलो तो, स्क्रॉल नहीं होगा।
क्या सर?
वो रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ अप मूव डाउन मूव कितना था,
एक सेकंड।
आ गया 0.5367 और 46.33, 5367 और 0.4633. So the expected value of the call in 1 year is 0.5367 into 20 plus 0.4633 into 0. तो ये 0.5367 into 20 करो, कितना है, 10.734. Now this is the expected value of the call in 1 year, right. यहाँ पे है at the end of this 1 year, 10.734. What is the present value of this expected call premium? Now the present value of the expected call premium is 10.734 by 1.03, कितना आ रहा है, 10.734 divided by
10.42.
10.42, exactly what we calculated using the put call parity, exactly जो put call parity से calculate किया वही आ रहा है, ठीक है ना. So we don't have to, once we have the no arbitrage premium of the put, we can use the put call parity to calculate the no arbitrage premium for the call. But the put and the call should have the same strike, should expire at the same time, and they should be on the same underlying. ये चीज का ख्याल रखना है कि जो पुट कॉल है वो उसका स्ट्राइक एक होना चाहिए, इट शुड एक्सपायर एट द सेम टाइम एंड दे शुड बी ऑन द सेम अंडरलाइन. सो पहले कॉल का निकाल लो, फिर पुट कॉल पैरिटी से पुट का निकाल लो, या पहले पुट का नो आर्बिट्राज निकाल लो, फिर पुट कॉल पैरिटी से कॉल का निकाल लो. और ये रिस्क न्यूट्रल प्रोबेबिलिटी क्या है, It's the probability assigned to an up move or a down move in the underlying, and it's calculated in such a way that a hedged portfolio earns a risk-free rate of return, right? It's calculated in such a manner. अभी गाइस एक तुम लोग करो कैलकुलेशन. अभी मैं यहाँ जब कैलकुलेशन सारा बैठा रहा था तो मैं सोचा कि जो सिग्मा है, वॉलेटिलिटी ऑफ द अंडरलाइंग था 20 था, मैं 20 पकड़ा था, राइट? That is the standard deviation in the prices of the underlying asset was 20%. इसको 30 के लिए कैलकुलेट करो और इसको what if the volatility of the underlying was 30? That is, what if the volatility of the prices of the underlying asset was 30%, and what if it was 10%? ये जरा खुद कैलकुलेट करके मेरे को बोलो. टेक 5 minutes 10 minutes और मेरे को बताओ. बाकी सब चीज अज्यूम सेम करना है. Risk-free rate is 3% and the price of the underlying at time 0 is 100. ठीक है. And calculate the put का premium, no arbitrage put का premium and the no arbitrage call का premium. तू घर आजा परदेसी. कुणाल आज उसके बाद मैं चला गया था गदर देखने, अपना फाइनेंशियल मॉडलिंग का क्लास के बाद. ऐसा पिक्चर नहीं देखा बहुत दिन हो गया. जब वो टुल्लू पंप के पास जाता है ना, मतलब मन कर रहा था कि सिक्का उछाल के फेंके. चलो 5 मिनट लो, ये दोनों कैलकुलेट करो. उसके बाद कैलकुलेशन के बाद मैं कुछ एक मतलब ये कॉन्सेप्ट समझाने के लिए कैलकुलेशन करवा रहा हूँ.
सर 30% पे भी कैलकुलेट करना, फिर वो जो दूसरा वाला
फिर
10% है उस पर भी करना है.
हाँ हाँ, दोनों के लिए. परदेसी कि तेरी मेरी एक जिंदगी.
ये पुट के लिए करना है ना?
पुट कॉल दोनों. और दोनों का स्ट्राइक 100 है. दोनों 1 साल में एक्सपायर कर, मतलब कैपिटल टी इज 1 ईयर. चलो मैं साथ साथ करता हूँ, जल्दी हो जाएगा. पहले 30% पे. So my S0 is 100. If volatility is 30%, price of the underlying in case of an up move is going to be 1.3 times the current market price, 130, and S minus is going to be 1 by 1.3 into 100. तो S minus कितना आएगा? 1 by 1.3 into 100, 76.92. ठीक है, तो रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ अप मूव डाउन मूव निकाल लो. यहाँ कर लेते हैं. रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ अप मूव इज 1 plus risk free rate minus 0.7692, which is the size of the down move, by 1.11.38.
सर पुट प्रीमियम 11.38 आ रहा है.
ठीक है, अपना चेक कर लेते हैं. 1.03 1.03 minus 0.7692 divided by 1.3 minus 0.7. So ये आ रहा है 0.4913 रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ अप मूव, एंड डाउन मूव है 0.5086. तो पहले पुट का वैल्यू निकाल दो, राइट. द इंट्रिंसिक वैल्यू ऑफ द पुट in 1 year, that is at its expiry, in case the underlying goes up, is going to be 0, and if it goes down, then the intrinsic value of the put is going to be 100 minus 76.92, that is 23.08. So the expected value of the put in 1 year is going to be 0.5086 into 23.08. ये आ रहा है expected value in 1 year is 11.734, but this is the expected value in 1 year. We need to calculate the present value of this expected value. 11.396 आ रहा है या 11.4 आ रहा है. तुम लोग क्या आ रहा है, ये क्या आ रहा है? आशा तेरा कितना आया था?
हाँ तो
पुट का वैल्यू
हाँ
11.38 आ रहा है.
चल ठीक है, मेरा 11.39.
मतलब वो डिस्काउंट करके.
हाँ ठीक है, वो मेरा 11.4 आया, सेम ही है, कोई खास बात नहीं. अब कॉल का निकाल लो. कॉल का जस्ट यूज द पुट कॉल पैरिटी. S0 plus
14.29 आ रहा है वो.
S0 plus C0, C0 plus X by 1 plus RF to the party. तो ये है 100, ये अपना आ गया 1140. C0 के निकालना है 100 by 1.03. तो ये कितना आया था? बोला आशीष.
14.29.
अब एक चीज देखो, ये मैं क्यों बोल रहा हूँ. जब सिग्मा 20% था तो यही कॉल और यही पुट का दाम क्या था? पुट का दाम था 7.51 और कॉल का दाम था 10.42. अब सिग्मा 30 हो गया तो यही कॉल का नो आर्बिट्राज प्रीमियम हो गया 14.29. यही कॉल which expires in 1 year and has a strike price of 100. तो देखो, when volatility has increased, the no arbitrage premium of the call has increased. और put का क्या था? Put का when the standard deviation was 20%, then the no arbitrage premium for a put option that had a strike of 100 and time to expiry of 1 year was 7.51. लेकिन volatility of the underlying बढ़ जाता है तो ये हो जाता है कितना था? 11.4 या 11.39, जो भी. So when volatility rises, the no arbitrage premium rises of both call and put, and this is the fundamental relationship that I wanted to explain, that as volatility will rise, the no arbitrage premiums of both call and put will rise, right? So the underlying concept behind this is that volatility is a friend of your option prices. It's a friend of those who buy an option. How is it a friend of those who buy an option? बोलो guys, कैसे है दोस्त?
सर कॉल ऑप्शन अगर मतलब बढ़ जाएगा, मतलब उसका अगर प्रीमियम, तो दैट वुड मीन कि मतलब
If
फ्यूचर
the देखिए
एक्सपेक्टेशन
स्ट्राइक प्राइस 100 है, प्राइस बढ़ गया, ठीक है, तो तुम कॉल ऑप्शन पे गेन किया, ठीक है, स्ट्राइक प्राइस 100 है, प्राइस ऑफ द अंडरलाइंग इंक्रीजेस, तो तुम कॉल ऑप्शन पे गेन करिए। ये देख नीचे टाइम है और यहाँ पे प्राइस है और ये मेरा स्ट्राइक है, राइट। सो इफ द प्राइस ऑफ द स्पॉट एसेट is more than the strike of the call, then I'm gaining on my call option। लेकिन अगर घट जाता है तो मेरे को कोई लॉस नहीं होगा, राइट। क्यों लॉस नहीं होगा? क्योंकि आई एम अ कॉल बायर। इफ द प्राइस ऑफ द स्पॉट एसेट गोज बिलो द स्ट्राइक, आई 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 वोंट एक्सरसाइज। तो मेरे को कोई लॉस तो होने वाला है ही नहीं। अगर ये इतना फ्लक्चुएशन आएगा, ये zigzag मूवमेंट इन द प्राइस ऑफ द अंडरलाइंग आएगा, तो मेरे को कोई लॉस, अगर अगर price of the underlying goes down and I'm long on the call, I'm I won't exercise क्योंकि I have a right but no obligation। but if the price of the underlying increases, तो I'm going to exercise the call। if the price of the underlying is more than the exercise price, then I'm going to exercise the call and make gains। तो इस लाइन के नीचे I won't exercise, इस horizontal लाइन के नीचे and इस horizontal line के ऊपर I'm going to exercise। so this volatility, ये जो zigzag movement है, this volatility in the underlying is going to favor the call buyer, because if the price of the underlying increases, he is going to exercise, make a gain। if the price of the underlying goes below the strike, so he is not going to exercise, uh, won't have to give any loss, right। so ये जो volatility है, this benefits the call buyer because he has everything to gain and nothing to lose, ठीक है। एंड पुट के लिए भी सेम सिनेरियो है। अगर पुट का है 100, बढ़ गया अंडरलाइन, तो लॉस होगा पुट बायर को, सो ही वोंट एक्सरसाइज बिकॉज ही हैज अ राइट टू सेल बट नो ऑब्लिगेशन टू सेल। घट गया, सो ही इज गोइंग टू एक्सरसाइज। so this volatility, this zigzag movement in the price of the underlying is going to benefit the put buyer also, right। and since volatility benefits call buyers, since it benefits buyers of call and put options, what happens is that the call premiums, the put premiums tend to rise as volatility increases। guys, ये idea clear है? कोई doubt है? Call and put prices tend to rise as volatility increases। why? because volatility is a friend of an option buyer, ठीक है। so if volatility causes the underlying to move in a way that does not benefit the option buyer simply won't exercise। and if it moves in the benefit of the option buyer, he is going to exercise and make gains। तो option buyer को पास आने को दुनिया है, जाने को कुछ नहीं है, right। if there is volatility, so volatility benefits the option buyers, and that is why volatility tends to increase the premiums of call and put options। so volatility is a friend of both option call option buyer and put option buyer। ये clear है concept? why does option premium rise with volatility? कोई doubt है? बोलो guys, कोई doubt है? आशय, तेरे कोई डाउट? हेलो हेलो हेलो।
ऑल क्लियर।
अब ये 10% भी निकाल दो, 10% पे तुम देखेगा कि कॉल और पुट का तो जो दाम निकलेगा वो 10.42 और 7.51 से कम निकलेगा। ये वॉलेटिलिटी ऑफ द अंडरलाइंग इज 10। ये जल्दी कैलकुलेट करो, फिर क्लास आज वाइंड ऑफ कर दो। अगला क्लास में 2 पीरियड बाइनोमियल मॉडल करेंगे, विच इज गोइंग टू बी वेरी सिंपल, क्योंकि अपने को अब सिर्फ लॉजिक नहीं समझना है, अपने रिस्क न्यूट्रल प्रोबेबिलिटी यूज करके ही कर लेंगे, ठीक है ना। क्योंकि लॉजिक ही समझाने में प्रॉब्लम होता है, ये लॉजिक समझाने में ही प्रॉब्लम है कि एक्स शेयर्स ऑफ द अंडरलाइंग लिया, एंड फिर ये कि अगर 1 साल बाद वैल्यू ऑफ द पोर्टफोलियो इज 54.56, what should be the amount that we no, what should be the amount invested in this portfolio at time zero. ये सब चीज़ें समझने में प्रॉब्लम है, बाकी तो कोई प्रॉब्लम है ही नहीं. तो ये कैलकुलेट करो. इफ सिग्मा इज 10, इफ द volatility in the underlying is 10. अरे बोलू 10 पे निकाला. कोई कॉल पुट का आया? करें तो अभी 100 है. अंडरलाइन का वॉलेटिलिटी 10%, तो एस प्लस होने वाला है 110 और एस माइनस होने वाला है 1/1.1 इंटू 100. कितना होता है? 90.91 आएगा क्या ये? 100/1.1 कितना आ रहा है? 90.9. हाँ, 90.91. तो मेरा कॉल का वैल्यू सी प्लस का वैल्यू होने वाला है x इज इक्वल टू 100 एंड t इज 1 ईयर. ये 10 होने वाला है और सी माइनस होने वाला है. सी प्लस हो गया कॉल ऑफ इंट्रिंसिक वैल्यू ऑफ द कॉल इन केस ऑफ एन अपमूव, एंड सी माइनस होने वाला है 0. रिस्क न्यूट्रल प्रोबेबिलिटी ऑफ अपमूव आएगा तुम्हारा 1 + 0.03 माइनस 0.9091 डिवाइडेड बाय 1.1 माइनस 0.9091. तो 1.03 माइनस 0.9091 divided by 1.03 divided by 1.1 minus 0.909. तो ये आ रहा है तुम्हारा कितना? 63.33 is the probability of up move और 36.67 is the risk neutral probability of down. सबके यही आ रहा है ना? किसी के कुछ और तो नहीं आ रहा है? आ रहा है ये गाइस? ये आ रहा है क्या? So the expected value of the call in 1 year is going to be 63.33 into 10 plus 36.67 into 0, which is going to be 6.33. This is the expected value of the call in 1 year. Present value of this expected call premium is 6.33 by 1.03, 6.414. तो मेरा C0 is going to be 6.14. तो ये देखो कैसे घट गया. उस समय कितना था? 10.42 था ना कॉल का प्रीमियम. जब वॉलिटिलिटी जब तुम्हारा था 20%, 10.42 था कॉल का प्रीमियम. अब जब 10% है तो वो रह गया 6.14. और पुट का भी निकाल लो. पुट का आएगा
सब मेरा पुट का 3.2 आ रहा है, अगर बाकी सबका भी वही आ रहा है तो वही यूज कर लेते
देख
हैं।
लेते हैं, मैं भी 3.2 चलो भर लेते हैं, वही होगा। ये मारते
सर
हैं।
इसमें इज देयर अ वे टू फाइंड आउट अ रिलेशनशिप बिटवीन वॉलेटिलिटी एंड पुट योर कॉल का प्राइस, मतलब कि कितना कम होगा तो वो कितना बढ़ेगा
ना
या
ना,
घटेगा
वो
वैसा?
वो वैसे नहीं हो सकता। तेरे को ये सब फॉर्मूला बैठा के वो कैलकुलेट करना पड़ेगा।
अच्छा
तो पुट का भी निकाल लेते हैं। तो P plus is going to be 0 because if the price of the underlying increases, put option is going to expire worthless, it's going to expire out of the money, intrinsic value 0, and P minus is going to be 100 minus 90.91, 9.09. So expected value of the put is going to be 36.67 into 9.09, जो की है 3.33. This is the expected value in 1 year. तो प्रेजेंट वैल्यू होने वाला है 3.33 बाय 1.03, विच इज 3.23। यही आया था क्या आयुष? 3.23 आया था ना? क्या आया था?
हाँ अप्रोक्सीमेटली यही है, वो मेरा राउंड ऑफ है तो 3.2 ही आ रहा है, सही है।
बस 2 3, तो ये 3.23 आएगा पुट का। कहाँ गया प्रॉब्लम? 3.23। तो देखने का बात ये है कि ना, एज वॉलिटिलिटी इंक्रीजेस, कॉल और पुट का जो प्रीमियम है दैट इज गोइंग टू इंक्रीज, and if volatility decreases, call or put का premium is going to decrease. ठीक है, because your put option and option premium is a function of volatility. Higher the volatility, higher the option premium, irrespective of whether that option is a call or a put, and lower the volatility, lower the option premium, irrespective of whether the option is a call or a put. And the reason is that volatility benefits the call and the put buyers, right? So if you buy a call and volatility, right, if volatility increases in such a way that the price of the underlying rises, then you gain on your long call position. But if volatility forces the underlying to go below the strike price, you don't lose because you are long call. So if your S is less than X, you simply won't exercise, right? So uh, call, volatility की वजह से, if you own a call option, you have everything to gain. If you bought a call option, you have everything to gain but very little, nothing to lose. But volatility buyer को सूट करता है, seller को कभी सूट नहीं करता, right? If you have written a call or if you have written a put, then a rise in volatility is going to hurt you. ठीक है, तो तुम अगर 20% वॉलिटिलिटी पे ये कॉल शॉर्ट किया होता, कॉल शॉर्ट किया होता, तो 10, इट मस्ट बी ट्रेडिंग एट 10.42। अगर वॉलिटिलिटी बढ़ के 30% हो गया तो ये कॉल का प्रीमियम हो जाएगा 14.29। तुम शॉर्ट किया हुआ 10.42 पे, प्रीमियम बढ़ गया 14.29, तुमको लॉस हो गया। इफ यू हैव शॉर्टेड अ कॉल, तुमको लॉस हो गया। एंड इफ यू लॉन्ग ऑन दी कॉल, तुम्हारे को गेन हो जाएगा अगर वॉलिटिलिटी राइजेस। गेन कितना होगा? 14.29 माइनस 10.42। ठीक है।
सर
हाँ
सपोज मैंने 1 साल का कॉल ऑप्शन लिया है, मतलब सपोज आज लिया है मैंने टाइम जीरो पे 10 रुपए के 10 ऑप्शन लिया है, तो 100 रुपए का हो गया मेरे को। आज 6 महीने बाद अगर उससे बाहर निकल के किसी और को बेचना हो,
हाँ,
तो फिर वो मतलब वो 6 से मतलब 6 महीने से उसको डिस्काउंट करके प्राइस निकाल सकते हैं क्या उससे?
वही करेंगे अपन। वो जो 2 पीरियड बाइनोमियल मॉडल में यही सब करेंगे। ठीक है,
अच्छा
अपने स्टेप्स बना लेंगे कि 2 पीरियड बाइनोमियल मॉडल कैसे लगने वाला है, पता है? एक सेकंड, इसको वही करना है नेक्स्ट। 2 पीरियड बाइनोमियल, तो 2 पीरियड बाइनोमियल मॉडल क्या, आपने ये 1 पीरियड बनाए, अब 2 पीरियड कुछ ऐसा होगा। ये होगा मेरा 2 पीरियड बाइनोमियल मॉडल S प्लस प्लस S प्लस माइनस विच इक्वल S माइनस प्लस एंड S माइनस माइनस। ये मेरा होगा 2 पीरियड एंड बाइनोमियल मॉडल। पहला पीरियड यहाँ खत्म होगा एंड दूसरा पीरियड यहाँ से चालू होगा और यहाँ पे खत्म होगा। ठीक है, तो ये एक्चुअली लाइन मेरा गलत बन गया। एक सेकेंड, तो सर रबर बदमाशी कर रहा है। एक सेकेंड रुको। सो ये जो लैटाइस बन रहा है ना, दैट्स गोइंग टू रिकम्बाइन एट S प्लस माइनस एंड S माइनस। एक सेकेंड, ये बन नहीं रहा, लेकिन ये एक सेकेंड, ठीक है, मेरा वन वर्ड हैंग हो गया है, तो थोड़ा सा ड्राइंग गलत, मतलब ये थोड़ा, ये लाइन अच्छा आ गया, ये लाइन और ये लाइन यहाँ बनना चाहिए था। ये जो यहाँ रोक रहा हूँ ना, ये यहाँ रुकना चाहिए था। ये रबर एक्टिव नहीं हो रहा है, लेकिन ये यहाँ पे खत्म होना चाहिए था। एनी हाउ, तो वो है मेरा, ये अपना 2 पीरियड बाइनोमियल मॉडल है। ये अपना कॉलेबल बॉन्ड्स और पुटेबल बॉन्ड्स को भी प्राइस करने में काम आएगा। एंड दिस इज गोइंग टू कम इन हैंडी व्हेन यू नो, अभी मैं अमेरिकन कॉल और अमेरिकन पुट्स को we are going to price in the next class. We are going to understand the 2 period binomial model, and we are going to price American call and American puts using the 2 period binomial model. ठीक है गाइस, बोलो आज का सब फंडा क्लियर है? कोई डाउट है?